First up on the show, Indian stocks surged to recover strongly on Wednesday after raising $386 billion in market valuation in the previous session. Analysts are looking beyond the election results but warn of volatility and more losses. The Sensex index surged over 2,300 points to end at 74,382, and the broader Nifty closed nearly 3.4% higher at 22,620. The Sensex and the Nifty opened in the green, but extreme volatility was on display in early deals. But both indices closed over 3% higher. This comes a day after nearly $400 billion were wiped off the Sensex index, and risks are still at play with many uncertainties about the formation of a Modi-led coalition government. Still, the run-up on Wednesday points to a strong recovery. Analysts say the Indian stocks will look past the uncertainty caused by elections as the nation's earnings and economic stories are still intact. Goldman Sachs Group's strategists, including Sunil Kohl, wrote in a note, "We remain constructive on Indian equities and see this weakness as an opportunity to accumulate." However, the bloodbath on Tuesday was driven by tallies that showed Prime Minister Narendra Modi's ruling party struggling to win a majority of seats in the national elections. This is a stunning result after exit polls showed he was on pace for a landslide victory. Investors raised questions about the new government's ability to push through politically difficult reforms with a thin majority. These reforms are seen crucial to sustain India's economic growth, already the world's fastest. Sunil Tirumalai, the strategist at UBS, said, as BJP does not have a simple majority, the bargaining power shifts materially within the alliance. Tirumalai added, most scenarios from here could be taken negatively by the market compared to expectations last week. Nonetheless, some investors are banking on continuity in the government's infrastructure and manufacturing-led driven boost, that is boosting the growth. Now, Dong Chen, the chief Asia strategist at Bank Pictet, said, I still think the policy direction of Modi will likely stay, which should support India's economy in the long term. Those thoughts were echoed by other analysts too, as volatility eased on Monday. India's volatility indicator, the VIX index, a gauge of 30 days, slumped more than 20%. This comes after the index surged to more than a two-year high Tuesday. The rupee traded near a record low touched in April after falling by the most in a year in the previous session. Now, strategists at Morgan Stanley wrote in a note, we expect realized and implied volatility to ebb in the coming days from its level on June 4th. They added that the ruling alliance has passed the halfway mark and is likely to form the government. And for more on this, we're now being joined by Madan Sabnavis, Chief Economist at the Bank of Baroda, who's live with us from Mumbai. And Mr. Sabnavis, thank you very much for talking to us this evening. What does the narrow margin of victory for the Narendra Modi government or the new government mean for India's growth trajectory?
In terms of sentiment, we already saw yesterday that the market did go down significantly. In fact, when I say the stock market went down, the currency depreciated, bond yields went up. But there's been a significant correction which has taken place today. So in fact, if I look at the Sensex today, it's probably at a level higher than what it ended on Friday. That is before the exit polls came. So I think we're back to normalcy in terms of the market. The rupee has also gained strength and the bond yields have also come down. Now, this said, I think the particular coalition which you're talking of is unlikely to really dent the pace of growth in the economy because the economy has been doing very well and has been supported by reforms which, to my mind, are something which will be acceptable even to the two major coalition partners which are being spoken of right now. So if we're looking in terms of the thrust to be given to industry, the thrust to be given to infrastructure, or for overall digitization of the economy, I think these have been pet projects even of the coalition partners in the past when they were ruling their states. So I don't see any inherent contradiction in terms of the basic economic policies. There could, of course, be certain differences when it comes to certain kind of social welfare expenditures. But we have seen that even the present government has been open to opening the purse when it comes to social welfare, as and when it's required. So while I think there would be a lot of apprehension in terms of the market until the budget is announced, because that would be a document which will give a clearer indication of where the government stands. But to my mind, I think we are in the right direction, and this may not really make much of a difference.
Right. So essentially, you're saying that the new government will be able to push through tough reforms going forward.
Yes, the reforms which are required to keep the growth ticking is something which will be done. But here I would like to add that there are certain reforms which have been pending in the last 10 years relating to land, labor, as well as agriculture. Those have been pending and they will probably still be pending. It would require wider discussion to get the acceptance, not just of the coalition partners, but also of the stakeholders. But those are really major reforms which haven't really moved significantly, even in the last two regimes of the government.
I see. And what is your take on the government's fiscal discipline plan, Mr. Sabnawis?
Of the fiscal deficit, I think the government is committed to moving towards this glide path of 4.5% of fiscal deficit by 25-26. And there's little reason for one to suspect that this particular target will not be met. And what we have seen is that it's a gradual movement which is taking place, which has been aided a lot by the inherent buoyancy in the Indian economy. So we have seen tax revenues being very, very buoyant. Non-tax revenue in terms of the RBI transfer of surplus has been a big plus for the government this year. This combined with the way in which expenditure has been managed, both in terms of capital expenditure as well as social welfare, will ensure that we are well on this particular path of attaining the 4.5% fiscal deficit mark by 25-26.
Mr. Madan Sabnawis, the Chief Economist at the Bank of Baroda, appreciate you joining us with your thoughts this evening. For all the latest news, download the WION app and subscribe to our YouTube channel.